The impossible just happened. For months, and I mean months, every analyst, every bank, every trading desk on Wall Street told us the same thing. $65 is the absolute ceiling for silver. It's the line that cannot be crossed. It's where the rally dies. They said the bullion banks would defend that level with every tool they have, every paper contract, every algorithm, every ounce of institutional firepower. $65 was supposed to be impenetrable concrete. Then today happened. Wednesday, December 17th, 2025. And the market didn't just touch that ceiling, it obliterated it. Earlier this morning, silver didn't hesitate, it didn't pause. It smashed through $65 like it was tissue paper and spiked all the way to $66.50 in a matter of hours. As I record this right now, we've pulled back slightly to around $65.80. And I know exactly what you rethinking because I can see the comments already forming in your mind. Was that it? Was $66.50 the top? Is this just another fake rally that's about to collapse back down? I need you to stop that thought right now and listen very carefully to what I am about to explain. What we're witnessing at this exact moment isn't a crash. It's not a failure. It's not weakness. What's happening right now is the single most bullish technical behavior a market can possibly exhibit after a major breakout. It's called a retest. And if you don't understand what that means, you're about to make a very expensive mistake. In this deep analysis, I'm going to break down the exact mechanics of what happened this morning. I'm going to show you why the price shot up so violently. I am going to explain the gamma squeeze mechanism that forced institutional players to buy against their will at escalating prices. And most critically, I am going to prove to you why this pullback to $65.80 is not just acceptable, it is necessary, it's healthy. It's exactly what needs to happen before the next explosive leg higher. If silver had kept climbing straight up without pause, it would have been unsustainable. It would have crashed hard. But by pulling back now and testing whether this new level can hold, we're building the structural foundation for what comes next. The wall at $65 has fallen, but now we have to defend the rubble and prove it's solid ground. This is the story of the breakout and why it's just beginning. The gamma mechanism. Why price exploded through resistance to understand why silver teleported from $64 to $66.50 this morning and why it happened so fast. You need to understand something most retail traders never learn, the plumbing underneath the market. You need to understand gamma. Gamma is a term used by professional options traders. It measures how rapidly a market maker's risk exposure changes when price moves. Think of market makers as the house in a casino. They're supposed to have the edge, the stable position. Here's what happened. Over the past several weeks, these market makers sold millions of ounces worth of call options at the $65 strike price. Call options are essentially bets that silver will rise above a certain level. As long as silver stayed below $65, those call options were worthless. The house was winning. They collected premiums from buyers and paid out nothing. But the instant silver crossed above $65, everything changed. Suddenly, those options became valuable. The house started losing money. And not just losing a little, losing exponentially with every additional penny silver climbed. When the price hit $65.10, just 10 cents above the strike, the market maker Zest computer systems started flashing warning signals. Risk models screamed danger. To protect themselves from potentially catastrophic losses, their algorithms automatically began buying silver futures contracts. They weren't buying because they believed in silver's value. They weren't buying because they wanted exposure. They were buying purely to hedge to offset the ballooning risk from those call options they'd sold. But here's where it gets interesting and dangerous for them. Their defensive buying pushed the price up to $65.30. But at $65.30, their gamma exposure became even larger, so the computer bought more, which pushed the price to $65.50, which increased the exposure further. So bought even more. This is the gamma squeeze, a forced feedback loop where hedging activity drives price higher, which creates more hedging demand, which drives price higher still. It's the exact same mathematical mechanism that sent GameStop to $400 in 2021. It has nothing to do with fundamental value or supply and demand. It's pure market mechanics mathematics expressing itself through forced buying. This morning, that mathematical pressure broke the institutional sellers. The spike to 66.50 was the sound of algorithms panic buying to cover accelerating risk exposure. It was a vacuum move, meaning there were no natural sellers willing to step in. Only desperate machines trying to plug a hole that kept getting bigger. So why did it stop? Why did we fall back to 65.80? Because human traders eventually intervened. Professional speculators saw the vertical move and took profits. The gamma buying exhausted itself for now. Reality reasserted itself. But the damage is done. The psychological barrier at $65 has been shattered. The market makers are wounded. And they now know with absolute certainty that the ceiling can be breached. The retest. Why pullbacks are actually bullish right now. Silver is trading around 65.80. To someone who doesn't understand market structure, the drop from 66.50 looks like weakness. It looks like the rally is failing. To a professional trader, it looks like confirmation that the breakout is real. There's a fundamental principle in technical analysis that most people never internalize. Old resistance becomes new support. For months, $65 acted as a ceiling. Every time we approached it, selling pressure materialized and pushed us back down. It was a concrete roof over the market. Today, we broke through that roof. Now we're standing on top of it, testing whether it's solid enough to support us. This pullback to 65.80 is the market's way of asking, is this level real? Can buyers defend it? Or was the breakout just a temporary glitch? We need to see buy orders materialize here. We need to see the price stabilize and hold above $65. If we can close today and the next several days above that former resistance level, it confirms that 65 is no longer a price to sell at. It becomes a price to buy at. However, I have to give you the warning. This is where the risk lives. If the price drops back below $65 and closes a daily candle beneath that level, that's called a failed breakout or a fake out. It means the sellers are still in control. And typically, a failed breakout leads to a harsh reversal, sometimes back to the mid-50s. So 65.80 is a battleground. We're in a buffer zone with 80 cents of breathing room above the critical line. Don't celebrate yet. Don't assume victory. We need to see how the daily close looks. We need to see if this new floor can truly support the weight of higher prices. The whale is still here, tracking the smart money. Remember the mysterious mega buyer we talked about before? The entity that absorbed $650 million worth of silver around the $63 level? Everyone's been asking, where did they go? Did they sell at 66.50? Did they dump their position on retail investors? I've been monitoring the order flow all morning, and I can tell you with reasonable confidence, the whale is still here. When the price dropped from 66.50 back to 65.80, massive block orders appeared on the bid side of the order book. Someone stepped in at approximately 65.75 and essentially said, I'll buy everything available at this price. This tells us something critical about institutional psychology. The smart money views $65 as cheap. Last week they thought 63 was cheap. Now they're willing to pay more. They're defending the breakout. They're re-putting a floor under the market to prevent it from collapsing back below the critical 65 level. This is not the behavior of a speculator looking to flip a quick profit. Speculators sell into strength. They take profits when prices spike. This buyer is doing the opposite. They're supporting weakness. They're stabilizing the market during vulnerable moments. Why would they do this? Because they understand what comes next. They know that if $65 holds as support, the next target isn't 66 or 67. It's 70, then 85, then higher. They're building a base camp before the next assault on higher ground. They're securing territory before advancing further. So when you see 65.80 on your screen and feel nervous, reframe it. You're not seeing weakness. You're seeing billion-dollar entities reloading for the next phase. The short squeeze, banks bleeding billions. The gamma squeeze was just the spark that lit the fuse. But the real fuel, the accelerant that can drive this market dramatically higher, comes from forced covering by short sellers. For decades, major commercial banks have played a profitable game in the silver market. They sell paper contracts when prices rise, then buy them back when prices fall. They've acted as a governor on the engine, keeping prices contained within a manageable range. But when silver crossed $65 this morning, the mathematics of their position flipped from profitable to catastrophic. According to the most recent Commitment of Traders report, commercial banks, code word for bullion banks, hold a massive net short position, roughly 80,000 contracts. Each contract represents 5,000 ounces. Do that math. 80,000 times 5,000 equals 400 million ounces of silver that they've promised to deliver, but don't actually own. They sold these paper contracts at $50, at $55, at $60. Every one of those positions is now deeply underwater. Here's the terrifying reality for them. When you're long an asset, the worst-case scenario is it goes to zero. When you're short, the risk is theoretically infinite. If silver goes to $100 or $500, they owe that difference. At 66.50 this morning, risk managers at these institutions woke up and realized they were sitting on potential losses that exceed their quarterly earnings. This forces a fundamental change in behavior. Normally, when silver rises, banks add more shorts to cap the price. But today they can't. Their credit lines are maxed. Their risk exposure is too large. Instead of adding shorts, they have to close existing ones. And how do you close a short position? You buy. You become a forced buyer competing with everyone else for limited supply. This creates what traders call a superbid, constant buying pressure underneath the market. It's why 65.80 is holding. The banks are trapped in their own positions, forced to buy at prices they never wanted to pay. Let me quantify the pain. For every dollar silver rises, the commercial short position loses approximately $400 million. Since the breakout started at $60, silver is up almost $6. 6 times 400 million equals $2.4 billion in paper losses. But that assumes they can cover at current prices. They can't. If they tried to buy back 400 million ounces right now, the price wouldn't stay at 65. It would instantly gap to $100 or higher. This is called slippage. The act of exiting makes the exit more expensive. The real loss isn't $2 billion. It could easily be $10 billion or $20 billion. This is why $65 was such a critical level. Above this threshold, losses become visible to shareholders and regulators. Bank CEOs start getting uncomfortable questions about solvency. We're watching a slow-motion financial accident. The banks are trying to exit gracefully, covering slowly and quietly. But the whale we discussed earlier isn't letting them. Every time they try to buy, the whale absorbs supply, forcing them to bid higher. This dynamic, this wealth transfer from institutional suppressors to those who held physical, is the essence of a short squeeze. The physical disconnect. The real price is $70. If you're only watching the ticker showing 65.80, you're missing the real story unfolding in the physical market. That number represents the paper price, the value of a futures contract promising future delivery. But if you actually try to buy physical silver right now, you enter a completely different reality. Major industrial users are quietly paying $70 per ounce or more to secure immediate delivery. This is the shadow price, the price that Samsung pays to keep factories running, the price the US Mint pays for blanks. Why would a manufacturer pay $70 when the screen shows 65.80? Because reliability matters more than price. Imagine you operate a solar panel factory where the assembly line costs $1 million per hour to run. If you run out of silver paste, the line stops. You lose millions. Your supplier offers two options: wait 3 weeks for delivery at the official price, or pay $70 and receive emergency supply today. You pay $70 without hesitation. The premium is nothing compared to the cost of halting production. Reports indicate this premium buying is exploding across supply chains. Electronics manufacturers are bypassing exchanges entirely, going directly to mines and refiners with cash bonuses to jump the line. This creates a shadow market invisible to most traders. Volume moves off exchanges. It doesn't affect the spot price immediately, but it drains physical inventory at an alarming rate. Eventually, this disconnect snaps. When exchanges run out of deliverable metal, The paper price must gap up violently to meet the physical price. That's when you see $5 moves in a single morning. We're currently inside that gap. The screen is showing a lagging indicator. The invoices are telling the truth. The retail squeeze? Dealers can't restock. Go to any major online bullion dealer right now. Look at the premiums over spot price. Normally when spot prices rise quickly, premiums compress because dealers want to move inventory fast. But right now, spot is up and premiums are simultaneously rising. Why? Because dealers are terrified they can't restock. They sold you a coin yesterday at $63. Today, to replace that coin on their shelf, they might have to pay 66 or 67. They're bleeding capital with every sale, so they widen the spread. They charge you $65 plus a $10 premium. They're effectively discouraging purchases unless you're desperate, or worse, they switch to pre-order. Ships in 4 weeks. You know what that means? They don't have the silver. They're taking your money today, hoping they can source metal next month. This is a dangerous game. If price rises to $80 in 2 weeks, the dealer might default on your order, refund your money, and apologize. This retail inventory squeeze is the canary in the coal mine. When dealers stop selling, it means wholesalers have stopped selling. When wholesalers stop, refiners have stopped. The entire chain is seizing. The psychological warfare. Your mind is the battlefield. We've covered the mechanics, the gamma squeeze, the short covering, the physical shortage. The math is on our side. The fundamentals are on our side. But there's one enemy that can still defeat you, your own psychology. The next few days will test your conviction. Volatility will increase. Headlines will scream warnings. Banks will attempt one final shakeout, a sharp drop designed to trigger panic and flush out weak hands. When you see green numbers in your portfolio, when gains that normally take months happen in days, your brain screams, "This can't be real, take the profit, run away." The banks know this. They count on it. They know retail investors aren't weak because they lack money, they're weak because they lack conviction. Expect wild swings. $3 drops in an hour, $5 rips the next hour. This is designed to induce motion sickness, to stress you into selling just to sleep peacefully. Don't give them that satisfaction. Volatility is the price of admission for generational wealth transfers. If you sell at 65.80, where do you go? Back to dollars losing 5% annually? To stocks at all-time highs? Silver isn't just going up. The dollar is going down. Silver is the mirror reflecting fiat currency collapse. The inflation truth? 65 is historically cheap. People keep saying $65 is expensive. Let's examine that claim with actual data. In 1980, the Hunt brothers squeezed silver to $50 per ounce, the all-time high. But $1 in 1980 bought vastly more than $1 today. If you adjust that $50 peak for official CPI inflation, it equals roughly $170 in today's purchasing power. Think about that. To simply match the inflation-adjusted 1980 high, silver needs to nearly triple from current levels. At $65, silver is trading at a 60% discount to its inflation-adjusted historical peak. It's the only major asset class trading below its inflation-adjusted high. Stocks are at record highs. Real estate is at record highs. Art, collectibles, everything else has exceeded previous peaks when adjusted for inflation. Silver is still recovering from a 40-year suppression cycle. When you feel like 65 is too high, remember, you're buying the most undervalued major asset in modern financial markets. We're not at the top. We're barely off the bottom. The exit strategy. When do you actually sell? If we're heading to $100 or $170, when do you take profits? Here's the secret of generational wealth. You never sell for cash. Cash is a melting ice cube. You only sell to swap exchanging an overvalued asset for an undervalued one. Right now, silver is undervalued. Eventually, at much higher prices, it might become overvalued relative to other assets. Watch the gold to silver ratio. Currently around 70 ounces of silver by 1 ounce of gold. Historical average is 40 to 50. In 1980, it hit 17. If the ratio drops to 30, that's your signal to swap volatile silver for stable gold, effectively doubling your gold stack without touching fiat currency. Or wait for the housing ratio. In 1980, you could buy a median use home for 800 ounces of silver. Today, at $65, you need roughly 6,000 ounces. When you can trade a few hundred ounces for real estate, that's your exit into tangible wealth. Don't trade for numbers on a screen. Trade for acres, for gold, for cash-flowing assets. That's how you lock in the wealth transfer. The tipping point has arrived. We've covered enormous ground: the breakout mechanics, the gamma squeeze, the bank losses, the physical shortage, the psychological warfare. Wednesday, December 17, 2025 will be remembered as the day the banks lost control, the day the $65 wall fell. The genie is out of the bottle. You cannot reverse this. The world now knows silver is scarce. They know the price was artificially suppressed. And they're rushing to secure positions. You're already positioned. You saw this coming when others were asleep. Now your job is simple. Don't move. Don't sell. Let the market come to you. The squeeze has just begun. The real move hasn't even started yet. Hold your ground. The ceiling is shattered. The sky is open. This is just the beginning.